back to accounting. I had a question, and the people in the classroom wanted to know, the woman in San Jose, we want to hear from you again. We want to know who you work for out in San Jose. Hello, San Jose? We want to know what you're eating, and we want to know who you work for.
Hi.
Who are you?
I actually just... Good. I actually just moved from Troy, New York. I graduated from another master's program at RPI, and I work for IBM out here in San Jose.
What's your name? Notice I timed that as you put something in your mouth. Thank you. I don't know. Sorry about embarrassing you, if I did, in fact. So, what are we doing in here? We are doing the cost side. What's the basis of today's class? And the basis of today's class is accrual. Would you do me a favor in San Jose? Would you turn down your mic, please? Because we can hear you in San Jose, okay? Thank you. The notion of accrual basis accounting. And that's as opposed to what? As opposed to cash basis accounting. And the accrual, the basic idea behind the accrual basis is matching. And what do we match? We match revenue to the period in which it's earned. We match expense to the period in which it was incurred. And so the whole idea today is to get some sense of what this accrual basis idea. And accrual accounting is GAAP. And GAAP means what? Generally accepted accounting procedures. Right? Principles, procedures, whatever. Right? And it turns out that firms who publish financial information must use GAAP for all of their financial statements posted in the year and for their earnings forecasts. So in my opinion, it makes sense to know something about GAAP, because if you are following what's going on in the stock market, you're following what earnings announcements are coming up, and those earnings announcements have a huge impact on value. Now value, by what do I mean by that? The stock price. And so what I thought we would do is take a little bit of a break from doing strict accounting and go to what's going on in the Wall Street Journal. Now, where am I? I am on Friday's paper. So Friday's paper, if you can zero in, let's see. Let's start here. So Friday's paper, this is the second column. Microsoft posted earnings in line with expectations, as it blah, 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 right? First one. Second one. eBay's net jumped more than sixfold. Now, what's the difference between earnings in the top one and net in the bottom one? And the answer is?
Aren't they the same? No. Or one's retained earnings, the other one's net income?
Well, technically, earnings is earnings per share, right? And net is what? Net income, right? So, what they're really saying is that their net income jumped by more than sixfold, whereas this is earnings per share, but in reality, they're really measuring the same thing, right? So your intuition was right, that even though, the net here may mean the net earnings per share, the net income divided by number of shares, and so they're really measuring the same thing. But I want to go down to the next one, and that is Ford's operating profit fell 33%. Is operating profit the same as net, which is the same as earnings per share? No. And the answer is no. It's not exactly the same, because operating profit would not include extraordinary items. right? If they had a loss due to a flood or something that's not part of normal operations, or if they sold some division that's not part of regular operations. And hence, those kind of activities would not affect operating profit, although they would affect earnings per share, right? So that you want to be specific. Again, to learn a lot about accounting, the reason to know more about accounting is to be able to then translate that accounting knowledge into what's going on in markets to help you better understand how value is created. Now let's go back to the first one. Microsoft posted earnings in line with expectations. Okay? Let's talk about that for a second. Suppose. Now, in this case, what are we talking about? Expectations. They published what about what? What did Microsoft publish? What are we talking about in that thing?
Financial statements.
Okay. So, we're talking earnings per share for what period?
Quarter.
Which quarter? Fourth quarter, year 2000, right? So, let's say we have fourth quarter, year 1999 rather, and then fourth quarter 2000. Okay? So, let's take a real simple example. Let's say that earnings per share were $1. My head's connected to my arm there. That's good. Earnings per share are $1 in fourth quarter of 1999. Now let's suppose earnings go to $1.20 in the fourth quarter of 2000. If earnings go from $1 to $1.20 in the quarter, right? What's going to happen to the stock price? Depends upon what? What the projected earnings are, right? And so, those of you who are following this stuff, let's put the forecasted, or we'll put street. Because often what you'll hear is, what the street expected is something else, right? So let's say the street expected $1.22. What's going to happen to the stock price? Now wait a second. So you're telling me this company has $1 per share earnings last fourth quarter. This fourth quarter goes to $1.20, and because they did so well, their stock price is going to go down? Why?
They'll probably warn first.
What's that?
They would warn first.
They would clearly warn first, right?
Hopefully.
But why is it the stock price would go down if you don't meet the expectations? What's the logic behind that?
You're expecting a certain growth, sequential quarter-to-quarter growth, or year-to-year growth. And if you can at least maintain a certain multiple, then...
Okay, so what's going on here is that as time goes on, the stock price, and this is time, the stock price does what? Either goes up or goes down or does whatever, right? And the stock price at any particular point in time includes what? Includes expectations for what's going to happen in the future, right? So the stock price at any particular point in time includes what? It includes expectations. Expectations are what? The guesses that the street is making. Now we say the street, what street is that in New York City? Wall Street, right? So the street is Wall Street, and who is the street? It's just the people, the investors, the people who follow particular companies. They publish their guesses, and those guesses are accumulated to something that we might call the street, which is just the people who follow these. Now, the street's not necessarily right or wrong. That's the basic idea. Now, so the thing to understand is that the stock price at any particular point in time is not going to be based on the increase in earnings, but this increase, if the street expected it to go up to 122, that increase was already embedded in the stock price maybe as of 12/15, year 2000. Now what happens is, as the street starts to realize that maybe they're not doing as well as the street thought, the stock price does what? It maybe goes down, right? And then we get to here at some point, and this was year end, 12/31. Now what? On January 20th, they come out and say that in fact it's 120. The street expected 122, and the stock price dips a little bit further. Does that make sense, everybody? And so the key thing is this operations operator, right? This expectation is what drives the stock price. And the expectation is based on what? An accounting piece of information. This earnings per share. Now, earnings per share is what again? It's equal to net income divided by what? Number of shares of common stock. Right? So when we talk about the earnings, or earnings per share, is how it's usually called, sometimes just earnings, we're talking about the earnings that could be distributed to each owner per share, basically. Questions about that? Okay. Back to accounting. In the notes, I am on page 2-12. Last example from chapter 2, then on to chapter 3. Last example from chapter 2 is inventory. So, if you go to the screen, our model for inventory is what? We have a cost. We're going to capitalize that cost into an asset called inventory, somehow defined. Finished goods inventory, if these are the things we're actually selling, right? And then, do we allocate this thing? And the answer is no. We don't allocate it. When does it become an expense? When title passes. When we sell that item. When it moves off our dock. When our customer picks it up. And so the initial entry is to increase an asset inventory and credit either cash or accounts payable, whatever it is. Then when we recognize the expense, what's our entry? Recognize a debit decrease in equity account called cost of goods sold, and then credit the asset account, decrease the asset account called inventory. Questions about that? The next thing about inventory is what I use to analyze inventory is a very simple model. And the simple model goes like this. The beginning balance plus what we purchased during the year is equal to the amount that went out the door, cost of goods sold, plus whatever is left over, called the ending balance. Does that make sense again? Let's try it again. Beginning balance plus our additions is equal to the amount that went out the door plus whatever is left over. Pretty simple, right? Now, bottom of page 12, we have an example. And so, while I go through the next couple of things, we need to start looking at that example. So, if we go back to the top, on the screen we see here that we have units of inventory, some in the beginning balance, some that we purchased. We take units times cost, gives us the total cost on either side. Notice the equal sign here. Next, the left-hand side, total cost of units that came in, which we sometimes call cost of goods available. And then the right-hand side is going to be broken up between the amount of units cost of goods sold that went out and the units we have left over, the value in our ending inventory. Questions? So the example at the bottom of page 12. We have a beginning balance inventory 44, accounts payable initially is 60. Now we buy inventory, and think of ourselves as a department store. We're not buying raw materials. We're just buying the items we're going to sell. And we purchased $300,000 worth of inventory. Terms 210 net 30. which means what? A 2% discount if paid within 10 days. The net is due within 30 days. We'll come back to that. Let's go back to the rest of the information. 3, payments made within the discount period is $200,000 gross. That's not the amount of cash. That's the amount of gross accounts payable that was decreased. 4, payments in after discount period $80,000. Returns of broken merchandise $6,000. Sales of inventory on account $500,000. Inventory on hand at the end of the period $47,000. Now, first question. What are we looking for in this question? What do we have to figure out? What don't we have? Do we have the beginning inventory? Yeah. Do we have purchases and stuff like that? Yeah. Do we have the ending inventory? Yeah. What's to figure out? Cost of goods sold. All right. So our goal here is to figure out cost of goods sold. But before we do that, let's go back to item number 2. So if you come off the computer screen for a second, please. Item number 2. There's 210, net 30. 210, net 30. What does that mean? What that means is, if we start out at period 0, day 1, coming up, on day 10, we can take a 2% discount. So in this case, the example said what? We took a discount on how much merchandise? $200,000 worth of merchandise, right? So we take a 2% discount on $200,000 worth of merchandise. What's our discount? 2 times 200,000. 2 times 2 is 4. So we have a discount of how much? $4,000. Does that make sense to everybody? Because you can only take a discount on the amount you paid. And if you look at item number, let's see here. Item number 3 says payments made within the discount period were $200,000 gross. So this is item 3 says we only were wise enough to take a discount on 200 of the 300. Questions? Well, now here's the next question. Should you take a discount? Should you try to take a discount? I guess would be a better way to put it. Is taking a discount a good idea? Say?
It is if you wouldn't make that discount back in interest in that period.
Okay, so it is if you wouldn't make the discount back in interest. What's the opportunity cost of not taking the discount? Does that make sense to you? In other words, what interest rate would you have to be earning to justify not taking the discount? What rate of return would you have to earn to justify not taking the discount? How big would that be?
A pretty large one.
Any idea? How much?
10 days. Yeah.
A pretty significant interest rate.
It's David, right?
Yes.
How would you calculate that?
10 days times the year times 2%, something like that.
Okay. It actually wouldn't be the 10 days. The discount is over what period? From day 10 to... So in other words,
okay, yeah, I'm sorry.
It'd be a 20-day period here, right? So if we take 360 days, because it divides very well by 20, divide by 20, we get 18 20-day periods in a year, give or take, right? Now, each one of these periods, how much are we going to save? What percent? 2%, right? And therefore, if we annualize that, we get a 36% annual rate. Now, what that means is what? That if we can borrow at 20% annual interest on day 10 to take a discount, we'd be willing to pay exorbitant interest rates as high as 20% to be able to take a discount because our opportunity cost is 36%. Does that make sense to everybody?
No.
No. No. Doesn't make sense at all. Our opportunity loss of not taking the discount is 36%. Is that amount intuitive? Got a lot of people shaking their heads up and down. That's a good sign.
I guess I'm not really even sure about the 2% discount. It's saying whatever I pay them, they're going to take 2% off that up.
You give them 196.
If you bought $100 worth of stuff, you pay them 98 if you take a 2% discount. Right?
And this is what I'm paying the people who have an account payable too.
Yes, you're buying it. Right? So you're buying it. Should you take the discount? Is the question that we started with. That's right.
Okay. Now I understand.
Now, so then the issue is, suppose you get to day 10. And on day 10, you just don't have the money. But Uncle Vito offers to lend you money at a 20% annual interest rate. Now, should you borrow money from Uncle Vito knowing that you have cash coming in? You know you'll have the amount of cash by day 30, right? You just don't have it on day 10. Would you be willing to borrow at a 20% annual interest rate in order to take the discount on day 10? And the answer is, well, the opportunity cost is 36%. If we can borrow at any amount less than 36%, theoretically it would make sense to borrow money and take the discount. Does that make sense to everybody? Okay. That's a nice theory. What really goes on in life? What goes on in life? Okay, so you buy something, let's say you sell something to some big company that used to operate out of Schenectady, whose name will remain unsaid in my class. Even though I've worked with these people and I know for a fact that they did this to me. Oh, excuse me. Didn't mean to get the superative here. So if the terms are 210 net 30, and they don't pay you until, say, day 90, should they take a discount? What do you think? If they can get away and not pay you till day 90, should you take a discount on day 10? What do you think? Well, if you don't pay until day 90, then what is the opportunity cost of taking a discount? This would be 80 days, right? 80 goes into 360 how many times? Oh my gosh. If I only had a calculator. 4.5. Times 2. 9%. Can GE earn better than 9% on their money?
Sure.
Absolutely they can. Right? Now, should they take a discount or pay on day 90? Obviously you pay on day 90. So smart cash management says what? Don't pay. Pay as far in the future as you possibly can. Smart cash management says what? Try to get the cash when? As soon as you can. Right? So if you're trying to manage your cash, and that's a very important thing in any business, particularly small businesses, you want to make use of terms either, well, to your benefit, whether you're buying or selling. Does that make sense to everybody? Okay. So, let's start recording some of these things. First of all, let's figure out what is cost of goods sold. So based on the information at the bottom of page 12, what is cost of goods sold? So if we would go to the screen, please. That's Bob's model, right? We have a beginning balance. What's the beginning balance of inventory from the problem? 44,000, right? What's the ending balance? 47,000. What did they buy during the year? There it comes. 300,000, right? Now, does that then mean we can figure out what cost of goods sold is? And the answer is no. Why? Because we took some discounts, right? What discount did we take? We took a discount on $200,000 worth of stuff, which means we only paid them $196 for $200,000 worth of stuff that we bought, but on our books we recorded at what? At the amount that we paid. So we have to take $4,000 off of the purchases. Now what else did we do? We returned some of that stuff. We ordered red, they sent blue, we don't like it. Right? So we send back part of the stuff. So net purchases were how much? 300 minus 10, 290. Therefore, what is cost of goods sold? If I only had a calculator, 287, right? Which is simply making the equation balance. Questions about that? Want to see it again? How do we do that? We started out with the beginning balance, ending balance, put in what we purchased during the year, then took account of the fact that we took some discounts, and we also sent some things back. Net purchases, 290. Now once we have 3 of the 4 variables, we can figure out the 4th. Therefore, cost of goods sold, 287. Kelsey?
Have you accounted for line 4 that says the payment made after the discount is $80,000?
Well, it turns out that the value of that inventory is going to be $100,000. Whether or not we paid, no matter when we paid it, right? In other words, the value of the asset's not going to change because we're paying it at 100% of its face value. Okay? Now, let's go through and create the journal entries for all this crap. And I'm going to go through fairly quickly, because you have everything written in front of you. If there's any questions, let me know. First, we buy this stuff. What's our entry? We debit an account called purchases, which is an inventory account, and we credit accounts payable. Second question, now we take a discount. Well, we decrease liability, accounts payable for $200,000. We credit cash for $196. What do we need to make this thing balance? We needed a purchase discounts account. What type of an account is purchase discounts? It's an asset account. That's exactly right. It's a contra asset account. Why? Because it has a credit. Notice we're crediting it. We're decreasing the asset. It has a credit balance. So in this case, purchase discounts is a contra asset account. Contra to what account in particular? Purchases, right? It's contra to purchases. Think about our diagram, right? We're offsetting purchases for the period. Questions? We make payments after the 10-day period. What is our entry? We reduce the liability because we're paying them off, accounts payable for $80,000, and credit cash because cash is going to go for $80,000. Questions? 4. We return broken, discolored, we just don't like it merchandise. What is our entry? Well, if we return it, we no longer owe them the money, so we reduce the liability, accounts payable. We credit an account called purchase returns. What type of an account is that?
It's an asset.
It's an asset account, a contra asset account. That's right. Sales on account $500,000. What's our entry? We debit an account called accounts receivable $500. Credit sales. Sales revenue, again, I don't care what you call it. The key thing is to understand it's an increase in an equity account and an increase to retained earnings, $500,000. Now, the end of the period adjustment. The end of the period adjustment is where, what are we doing? We're recognizing cost of goods sold. Let me say that again. We're recognizing cost of goods sold. If you come off the screen for a second, let's make sure we understand what's going on. There are 2 methods for counting for inventory, broadly defined. One method is what's called the perpetual inventory method. The other method is called the periodic inventory method. Now, the perpetual inventory method looks like this. Every time there is a sale, we record the cost of goods sold that should be attributed to that sale. We are perpetually updating cost of goods sold. So every time we make a sale, the computer then goes and records the cost of goods sold attached to that particular item. The periodic method looks like this. We have beginning balance plus purchases. That's equal to what? Cost of goods sold plus ending balance. Now what happens is, using the periodic method, we know the beginning balance, which in this case was 44. We know what was purchased during the year, net of discounts and whatnot, which is how much? 290. But in order to calculate cost of goods sold, how do we do it? Well, in this case, what did we get? We knew that ending balance inventory was how much? How do we know that?
We checked our supply room.
We went out and counted everything up, right? So we took an inventory of our inventory, right? We went out and counted everything up. And so we counted everything up, so we found out we had 10 of these and 12 of them, 14 of these. We multiplied it times the value or cost. We added all that crap up and we got what? The total value of inventory is $47,000.
How did you match the cost to different items?
Well, you keep track of all the costs, right? That's what this is. We know all the purchase prices. We know all the costs.
But different times, different price.
Well, it depends upon how you do it. And in chapter 6 or 7, we're going to talk about how to account for inventory a little more specifically. And that turns out to be a very good question. Your intuition is exactly right. But basically, how do we get cost of goods sold? And the answer is, we back into it. We know the amount that was available, right? Which in this case is 334. We subtract out the amount we had left over, and therefore the balance is what? Cost of goods sold. 287. Does that make sense, everybody? And again, this is the periodic method. How can you tell whether the firm uses the periodic method or the perpetual method? And the answer is, at the end of the year, if the firm does not have cost of goods sold on their books, which method do they use? The periodic method, right? If they have cost of goods sold on their books at the year end, what method do they use? Perpetual, because they're always updating cost. They're always putting cost of goods sold on the books every time they make a sale. Questions? In this case, which method does the firm use? Uses periodic, right? Because we went out and counted up inventory, then backed into what cost of goods sold would be based on our ending inventory balance. Questions? Okay, so now it's the end of the year, and it's time to make an entry to represent this $287,000, right? Now, in order to do that, remember we recognized that account called purchases, which was, I think, journal entry number 1. What type of an account was that? It's an inventory type of account, right? So now we go, and what we're going to do is we're going to close out our purchases account, and we're going to convert it into an account called inventory, an ending balance. So the end of the year adjustment, the first part, if you go to the screen, please. The first part is inventory went from what to what? Beginning balance was 44. Ending balance was, therefore inventory increased by 3, right? Next, we recognize cost of goods sold. We just calculated. So we debit decrease in equity account for $287,000, right? Next, we close out that purchase discounts account because we're going to close out the purchases account into what account? Inventory. We close out our purchase returns, again, for the same reason. And lastly, we close out purchases to the tune of $300,000. Now, I kind of ran out of space here. The $300,000 is a credit, right? And these other numbers are debits. Notice 3 and 287 is 290 plus 10, 300. Questions about that? That's a little tricky. Let's think about that for a second.
Positive on the black purchase. Is that what you're saying? You ran out of room.
That's a mistake. You're right. This should be negative right here. You're exactly right. I missed that one when I went through before class. Now, when we think about this, I have a question for you. When we bought this stuff, right? Why did we create this account? Come on, if you come onto the screen for a second. Why, guys? Thank you. Why did we record purchases into a separate account called purchases? Why didn't we just put it in the inventory? Does that make sense, everybody? And the answer is because Boylan likes to use boxes. And in order for Boylan to be able to use Boylan's boxes, I had to create a separate account. And so that separate account was called purchases. And that let me fit it into, right, the mechanism that I think is important for you to understand in terms of inventory. So what I did was I tailored the accounting to meet my needs in trying to explain what was going on to you. Does that make sense? Let's ask the same question a different way. Why does this firm record an account called purchase discounts? Why don't they just reduce purchases? They set up a separate account called purchase discounts. Why?
To keep track of how much you saved.
To keep track of how much you saved. Why do they want to know that? Maybe.
Just to make sure that they're saving as much as they can, over a period of time.
So in other words, in order to help them control their operations, they set up a separate account called purchase discounts. And then whoever reviews that's going to want to make sure that they've taken every discount they can possibly take. Now, if we just netted the discount against inventory or against purchases, you wouldn't be able to isolate out what discounts did we take. Either way would be reasonable, right? But what we did was we augmented our system to be able to determine how many or what was taken in discounts because we want to maximize the amount of discounts that we take, depending upon the terms. Does that make sense, everybody? How about the next one? Why do we keep track of purchase returns? Why would we bother?
Well, I also have a question too, but just so they have a history.
Start with an answer.
For the history, to see how much, see if they have a trend of returning more or less goods.
Okay, so if we're returning a lot of goods to one particular vendor, what do we do?
Stop going to that vendor.
Right. So we keep track, and we probably keep track of our returns by vendor, right? By product by vendor, more specifically, and we do it for quality purposes. But unless we isolate that out in our accounting system, right, we won't know who the good vendors are and who the bad vendors are. Does that make sense? Now there's a trade-off, right? Because the more complex we make our accounting system, the harder it is to interpret. So we keep adding accounts when we need specific information, but the trade-off is if we add accounts willy-nilly, we have too many accounts and it's hard to analyze. You had a question, go ahead.
Yes, so where would you put opportunity costs in this?
You wouldn't.
You wouldn't?
No, financial accounting does not consider opportunity costs. It includes actual losses. Because that's a little, in general, it doesn't include.
Would someone just maybe take this stat and then consider opportunity costs with it separately?
Okay, the decision would consider opportunity costs, but the GAAP would not. GAAP accounting would not consider opportunity costs. Right, this is the way to think about it. Questions? Okay. Any questions about the cost side of what's going on? So all the entries appear on page 13, and we're moving on to revenue. So continue on today's theme. And today's theme is what? Accrual basis accounting. We first looked at the expense side, the cost side, and a cost becomes an expense when the value of that cost is used up, right? When the service potential from that particular cost, which we might call an asset, gets used up. That's what a cost is. And we try to match up the depreciation in value with the period in which that value was reduced. Now, revenue side, similarly, we try to match when we earn that revenue to the period in which it appropriately should be attached. So the key here is, when did we earn it, as opposed to when did the cash come in. So when the cash come in is not the salient part. The salient part is, when did we earn that revenue? And we are going to find that, let's go through. There are 4 revenue activities. Right? I'm at the bottom of the page here. We sell inventory, we sell services, we let someone else use our assets, or we sell an asset other than inventory. Now, guidelines for revenue recognition. Where am I in the notes? You're probably asking. I am on or about page 2 or 3 in there. It's revenue when the earning process is complete and when we can measure the exchange. Right? We know what, in fact, will exchange hands. The value that was transferred. That's when it's revenue. Next question. So the 2 questions you need to think about are, 1, when was the revenue recognized, and 2, how much? Right? So those are the 2 questions that we need to think about anytime we are going to recognize revenue. Example 3.1. Suppose we are manufacturing a good. When can we recognize revenue? One is during production. That's theoretically possible. It's unlikely, but possible. The second is at the end of production. The third is at the time of sale. The fourth is when the cash comes in. Now, of these 4, when do we usually recognize the sale? And the answer is number 3. What percent of the time, of all sales transactions, what percent fall into category number 3? What'd you guess? 35%? 45%? 99.999% of the time, it's a sale when title passes, right? When we sell the good. Under special circumstances, we wait until the cash comes in. Under very special circumstances, we recognize it either during or at the end of production. But generally speaking, we recognize it at the time of sale when title passes. In terms of a picture, item 1, we produce the goods, we sell the goods, cash comes in, the 3 boxes. 1 was the beginning of production or during production. 2 is at the end of production. 3 is, and the key here is when title passes, right? Now, also remember the line, possession's 9/10 of the law. So if your customer has it in their possession, for the most part, that's a sale. But the key thing is when title passes. Under special circumstances, we don't recognize the revenue until the cash comes in. Now, so number 3 is 99.9% of the time. How about number 4? What would be in a situation where we don't recognize the revenue until the cash comes in? And why would we do that? You can come off the screen in the back. Why?
Sure whether or not you're going to get the cash?
If you're unsure, if it's a very risky customer. Now, the example of very risky customers are installment sales. So if you go to a store like Sears and you buy a new refrigerator and you negotiate a 2-year installment loan to buy that refrigerator, that's called an installment sale, and Sears technically is not allowed to recognize the revenue until the cash comes in on a monthly or quarterly basis, whatever the contract says. But again, the key is because of risk. So we wouldn't recognize the sale until cash comes in because it would be too risky. Questions? Okay, back to the screen for a second. When will we recognize revenue during the production of a good? When or what? What's an example of that?
When deposits are made.
Deposit is a good guess. Turns out that's not right. We'll talk about that in a second. That's a very good guess.
If you pre-sold it.
What's that?
If you pre-sold it.
Well, that would be like a deposit, I think. So when will we recognize, say, some revenue halfway through production? Well, suppose you're building a bridge. Go ahead.
Progress payment from the government, perhaps?
Progress payments for the government on a long-term contract, that certainly could be the case. That's right. That's one example. The one that's usually given, though, is a long-term contract, which a government contract probably would have been in the example he just suggested. But suppose you're building a bridge. The bridge takes 3 years to build. Should you recognize revenue in year 1? And the answer is, well, if we're delivering value to our customer, a certain part of the final price should be considered revenue to match it to period 1. And so that's called the percent of completed contracts method. Now, the only one we're going to cover in this class, right, not the percent of completed contracts. We're not going to worry about installment sales. We're only going to talk about regular sales in this class. But I wanted you, many people who take this course are engineers and or you work for companies that have huge projects. And I wanted you to be aware that they can recognize revenue on long-term projects using some estimate based on cost. And who cares how that's actually done. And under special circumstances, Sears, Montgomery Wards, used to be Montgomery Wards, you recognize revenue not until the cash comes in under very risky situations, but most of the time when the goods are sold. Let's see here. Example 3.3. So in the notes, I am on page 3-7. Page 3.7. We sign a $100,000 contract to manufacture a machine. We're going to deliver it in a future time. We receive an advance payment of 20%. 20% of the asset is $100,000. Subsequently, we build the machine, we deliver the machine, and that's the key thing, right? Not that we built it, but that we delivered it. That title passed, and subsequently collect the balance of the cash, the $80,000. Now, when we get to 20, how do we record the 20? That's the first question. We debit increase in asset called cash. And is that cash revenue? And the answer is no, not yet. Good question. Why not? Dave?
For some reason, you go back on your contract and don't produce the machine, you're going to owe that.
Because if you don't deliver the goods, do you owe the $20,000 back? Have you earned the $20,000 at this point? Have you earned it?
No.
And the answer is no. And that's the key thing. Have you earned it? And the answer is no. So we record it as a liability. Why? Because we owe them the product at this point. We get the cash, we increase the asset, but we recognize a liability because we owe them the value for what we promised to deliver. Right? Okay, subsequently, we deliver the rest of the machine. The entry is, I don't know.
That advance payment is a liability because it's something that's owed.
Where we owe them the machine, right? They gave us the cash, we owe them the machine, or we owe them their money back.
Right.
Right, so we recognize a liability for 20. Now we deliver the rest of the machine, and the entry is, we get the cash for $80,000. We reduce the liability that we recorded initially for 20. We get rid of it, right? We take it off the books, and we recognize the full amount as a sale, the full $100,000, but not until when? Not until title passes. Exactly right. Questions? Now, suppose it was a non-refundable deposit. Suppose it's a non-refundable deposit. Go back to entry number 1. Is that revenue when we get the cash? And the answer is no. It turns out accounting is, the accounting rules for revenue recognition are very, very precise. Even, now this is generally speaking, right? But even if we have a non-refundable deposit, technically that deposit doesn't become revenue until we deliver the product. Now, if at the end of the product cycle something happens and we end up recognizing the $20,000 as revenue even though we never delivered the product, that wouldn't happen until later or down the road. I mean, and the reason is because GAAP, right, the accounting rules, what's called the FASB, the Financial Accounting Standards Board, which pretty much makes GAAP, makes the rules, right? Say that again. Boylan, he's acronyming FASB, the Financial Accounting Standards Board. And who are they? These are the people who make GAAP. And who is that? And the answer is, well, about half of them come from accounting firms, about half come from industry. So this group of people, for the most part, put together the rules and regulations that we call generally accepted accounting procedures. And what these people at the FASB, they try to make sure that people never recognize revenue until they earn it. Because when you recognize revenue, what happens to earnings per share? It pops up, right? So in other words, if we allow firms to recognize non-refundable deposits as revenue when they get the cash, then that will bump up the earnings per share before they actually deliver the product. And so GAAP suggests that it should not be a revenue until you earn it, and that doesn't happen until you actually deliver the goods. Bill?
What about in the event where the customer may order something, you have a non-refundable deposit, and then a week later they cancel, but you've already received the money? So right then,
once the transaction is complete and they've canceled, then it's revenue, right? In that case, it would be. But if you still owe them the good, and it looks like you're going to deliver the good, at that point, it's really not revenue yet because you haven't delivered the product or service. You haven't earned it, technically. Questions? Okay. Let's see. Going on. Question 3-6. Example 3-6. Page am I on here? I am on page 11 in the notes. At least 11 on mine. So example 3-6. So suppose we make a loan. We're loaning money, we're acting as a bank in essence, and we lend $10,000 on a 1-year note dated May 1st, 2000, bearing an interest rate of 12%. Now why did I pick 12%?
12 months.
12 months. You can thank me later for these wonderful numbers, okay? In fact, throw cash at me. Interest and principal are due on April 30th, 2001. That's coming up. So what is your job in this example? What's the accrual issue? The accrual issue is what is revenue as of when? December 31st. Right. So in this example, the question is what is revenue as of December 31st? But we're going to record the journal entries as we go along. And the first journal entry is the fact that cash went out the door. So, to record the loan on May 1st, we record an asset, and in this case I'm calling it loan receivable, just like account receivable, but it's technically a loan, right? Just be a little more specific, for 10 grand, and we gave them cash, cash goes down for 10 grand. Now, it's the end of the year. We accrue interest to the tune of $800. What is our entry? Our entry is to increase an asset called accrued interest receivable. And again, I don't care what you call these assets as long as you know what type of an account it is. You could call it interest receivable, accrued interest receivable, whatever you want. And we recognize interest revenue for $800. Questions about that? How do we calculate that? Interest rate per year, 12%, times the outstanding, times the balance, 10,000, times the number. So we prorate it based on the number of months. So we take 8/12 of 1 year's worth of revenue. Turns it to be $800. Questions? In our T accounts, first thing, we record the loan for 10 grand, credit cash, debit the asset, loan receivable. Uh-oh, I see a mistake. What's the mistake here in accrued interest receivable? Should be an asset account, right? So debit should be positive, credit should be negative. I missed that before I came to class. So sorry about that. So we should be debiting or increasing an asset, although the T account is in fact wrong, for 800, and crediting, recognizing an increase in equity account called interest revenue for 800. Questions? Okay. On April 30th, we received the balance. Or what do we actually get? That's wrong. That should actually be 400. Let's see what happens here. So as of year end, yeah, that should have been 400. Okay, so pardon me while I. Oh, this is working well. Okay, you can go back now. So the entry as of April 30th should be accrued interest receivable for 400, interest earned, interest revenue for 400. And again, that's the 4 months in the second year. Questions about that? Now, all the cash comes in. How much cash did we get? The pays of $10,000 plus what? 12% times 10,000, $1,200. Total $11,200. So we're getting $11,200. What's the entry? Debit an asset called cash, $11,200. Take the loan off the books, which now is $10,000. Take accrued interest receivable, the $800 from last year plus the $400 we just put on the books, total $1,200, and therefore everything balances. Questions about that? Does that make sense, everybody? Mike?
It all makes sense. I just want to ask a quick question. So that $800 from December 31st, 2000, is that taxable? Would that be something that accounting,
Yes.
the procedure would work out even though you collected no money, so the taxes on it?
Yes, you would. So for GAAP purposes, you would, well, okay, the answer to your question is actually a little more complex.
It depends on the law, but I mean, as far as
Generally speaking, the firms are going to use accrual basis policies for tax purposes, and therefore that $800 in the first year would be taxable income. So you would have to pay tax on it. Yes, generally speaking. Questions? Okay, last topic for tonight, and we're not going to finish the last topic. Oh, no, let's go to, second to last topic, and we will finish this. Example 3.7. So in the notes, I'm on page 13, I guess, 313. So now we have discounts again, except for instead of having purchase discounts, we're going to have sales discounts. Right, so in other words, it's the other side of the coin. We did purchase discounts a half hour ago. We're doing sales discounts now. And so the example, we have a beginning balance of accounts receivable of $1,000. Sales of inventory on account, $1,000. Terms, 210, net 30. payments made within,
Sales supposed to be 10,000.
should be 10,000. So this number here should be 10,000. Again, pardon my totally annoying tendency to correct things here. So sales on account is 10,000, right? And then payments received within the discount period, 5,000. And these are payments that we are receiving, right? Again, this is the other side of the coin. Merchandise returned, that's returned back to us, right? We're receiving the merchandise, $500. And then payments after discount period, 4,000. How do we record this stuff? First, a sale on account. We recognize an account receivable for 10 grand because we have not received the cash yet. Recognize sales revenue, 10 grand. Questions about that? Second entry. We now have a discount that we need to account for. And it's a sales discount. 2% times $5,100 discount. So what do? We're going to receive cash to the tune of $4,900, recognize a sales discount of $100, and reduce accounts receivable, credit accounts receivable for $5,000. Because they no longer owe us the $5,000, right? But we're only receiving $4,900. Now here's the question. This sales discount account, what type of an account is that? Well, anyone who can read sees it as an equity account. But why is it an equity account? Okay. The best way to think about it is it's a contra account. Contra to what? Contra to sales. Because all this really does is reduce the amount of cash we're going to receive or reduce the amount of the sale. Because we record the sale at the amount of value we're going to get. In this case, the value goes down by $100. So it actually reduces sales. But we're putting it into a separate account called sales discounts. Why? Because we think that gives us better information for making decisions. So by creating a separate account for sales discounts, we think that gives us better information for making decisions. Why? How would that be useful?
If we were receiving a lot of sales discounts, we might want to discontinue them.
Right? Anytime we analyze our credit policy, what do we analyze? How many people are taking our discounts? How many people are paying late? For instance, suppose your company has total sales for the year of $98 million. That make sense, everybody? And total expenses for the year were $93 million. Therefore, net income for the year is how much? If I only had a calculator. 5. Now, it turns out that every one of your customers does what? Takes a 2% discount. What might you do? The discount is what? $210, net 30. That's your discount. What might you do, Dave?
Discontinue the discount.
So would you get rid of it totally?
For shorten the period.
Lower it. Make it 1%.
You might make it 1%, right? Suppose we change our discount to 110, net 30. And suppose all of our customers continue to buy from us. What effect would that have? What would happen to sales? By how much? It go by $1 million, right? So go from what, 98 to 99. What happened to expense? Stays the same at 93, right? What happens to net income? Goes up to what? 6. So this diddly little squat reduction in our credit terms did what to net income? Increased it by 20%. Now, if you're CFO at GE, what would you do for a 20% increase in earnings? You'd eat your children for a 20% increase in earnings. Does that make sense to everybody in this room? Okay. Questions? So we're back to the question at hand. So the last thing we did, if we go to the computer, is we recognized the sales discount. Why do we do that? Because we want to be able to analyze our credit policy. That's why we create a separate account. Next, we recognize the fact that people return some goods. What's the entry? Well, the entry is, again, we're reducing the amount of sales returns, and we're reducing accounts receivable. Now, we'd also be recording the inventory, right? Now, I'm not going to do that here, but you should also, if we physically receive the inventory back, we have to make another entry to record inventory at whatever the value might be. Last, we received $4,000 from sales, debit cash for 4, and credit accounts receivable for 4. Questions? Okay. If you take me off the screen for a second. I want to spend a couple minutes setting up what we're going to do next time. So in the notes, I am going to be talking about what we call uncollectible accounts. And we're going to start with that next time. But I'm going to explain the basic idea right now. The basic idea goes like this. Suppose it's the year 2000. And we make sales during the year 2000, right? We have all these sales. Now, a normal cost of doing business is the fact that what's going to happen? Some people are not going to pay. It's a normal cost of doing business. Every firm in the world has this problem. Some people don't pay. And what's that called? It's called a credit loss. Sometimes it's called bad debts. Now, so suppose we have sales during the year, and the sales total 100 million. And we have this one account for $40,000, and that account goes bad. What entry do we make? So we have sales during the year, and we get a letter from this customer that says, "Dear Bob, I never liked you. I and my company are moving to Jamaica Mine. We refuse to pay. Have a nice life. Love, Jerome." Now, that doesn't come in until, say, February 10th of the next year. What do we do? Well, what we do is if we use the direct method, on February 10th of the next year, we record an entry. What's that entry? It would be an adjustment, agreed. But what would the entry be? Okay, we don't like the word reserve in accounting.
Debit equity.
Okay, we're going to debit equity, reduce an equity account. What do you want to call that? Huh? Bad debt, credit loss, doesn't matter what we call it, right? Is it a retained earnings account? Yes, it is. called bad debt for 10,000? Yeah, that's what I said. You can see I wrote it right there. And then credit what? Accounts receivable, right? Because they're no longer going to give us the cash. We're not going to receive the cash. So we reduce an asset account, accounts receivable, for 40,000. Now it turns out that accounting being the Financial Accounting Standards Board and GAAP has a big problem with doing it this way. Why is that? What's the problem? Why would GAAP dislike the method that we just talked about, and that's the direct method?
Because your accounts receivables open at the end of the year and they carry over.
Well, we almost always have accounts receivable open as of the end of the year. When you're close. A little more.
Because you're not really accounting for the sales that you did have. I mean, you had a set amount of sales. It's just you had a customer that refused to pay.
Okay, Dave. I think you got it, Dave. Bill.
Oh, because we counted it as a sale when in fact we didn't receive the money.
So would it be part of net income?
We're getting closer here.
We don't have a zero balance at the beginning of the year.
Well, we could force that. Okay. And you're all. I think you have it. And the key here is matching. The way we did it, the sale was in the year 2000, but the expense attached to that sale didn't get recognized till when? The year 2001. And the whole point behind matching is what? We match you this period's expenses with this period's revenues. And so this loss up here is a normal cost of doing business, right? That loss appropriately should be offset against what? The year 2000 revenues. Does that make sense to everybody? So in order to appropriately match, right, this loss, the 40,000, was a loss that really was generated through the year 2000 revenues. So that revenue appropriately should then get offset by this $40,000. Now the problem is what? As of 12/31, did Jerome send us that nice love letter? And the answer is no. So what do we have to do? How do we do this? And the answer is, as of 12/31, what we do is we estimate. We estimate what bad debt expense will be for, in the example I just talked about, the year 2000. Now, estimate, another word for estimate is what? Guess. We take a slag and I'll let that one go. We make a guess as to what we think will have happened during the year 2000. And so we estimate this thing called bad debts expense. And when we do that, it allows us to match an estimate of bad debt expense for the year 2000 against the year 2000 revenues. Does that make sense, everybody? Okay. In the notes, the example we're going to work through is on page 318 and 319. On page 318. Generally speaking, there are two approaches for estimating bad debt expense or estimated credit losses. One is the percent of sales method. The other is the percent of outstanding receivables method. And people away from here can't hear a word I'm saying because my microphone just left, so to speak. Let's see. So the percent of sales method, if you go to the screen, please. The percent of sales method is a fairly easy method to use. All we do is we take whatever the sales amount is for that period, multiply it by some estimate, 2%, 1%, 3%, totally at our judgment, right? It's our guess, and we use that as our percent of estimated losses or estimated bad debt expense. The other method is to use the outstanding receivables, where we take some estimate, some percent, multiply by the ending balance in accounts receivable, and the net amount we use to then figure out what bad debt expense will be. So I'm going to leave it right here for today. So in class a week from tonight, we're going to start out talking about how we estimate bad debt expense. So, be aware that we started it now. I'm going to ask you to look at it so that next time when we go through it, I can go through it fairly quickly because there's lots to do next class. Any questions? You all have a great week. We'll see you next Monday.